Good evening, everybody. Michael Silva here. You're watching the Stock Market Brief Show. Something very interesting today happened, and I'm going to be pointing that out because it goes to show you that there is little margin for error in these markets. So we got to hope for the best, but we got to prepare for the worst. That's what we're going to be talking about in today's Stock Market Brief Show. We'll get into some of the parabolic moves taking place in the market and various different names. We're going to go into some intermarket things that are taking place as well, and then dive into the S&P 500 and go over some very specific levels. All that and more on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis. Make sure to hit that thumbs up. Let's get into it. All right, everybody, welcome back to the show. I have 6 charts on my screen right here, and I just wanted to call out, so AVGO, Broadcom, right, this is the big one to watch, and it reported earnings after the bell, and yes, it's recovered some of it, maybe all of it. We'll see where we open, but what I wanted to call out that I found so interesting was it did come into its lower expected move on the earnings call, and when that took place, look at what happened very quickly after the market closed. This is NQ on a 30-second time frame, a very huge hit back into the opening range. Now it's since recovered, but this goes to show you just how little margin for error that there is in some of these names that have been high flyers and the control that they can have on the market. More specifically, I'm talking about NVIDIA. NVIDIA has been on a monster move. It was up another 4.47% today, and we're going to be talking about that. Now, if I look at the other names that have been reporting earnings, Costco is a big retailer. That's down there by its lower expected move. We had Marvel that has recovered some, so we'll see where these open up. But if they do continue to come back down into these lower expected moves, that could be a bad sign for some of the semiconductor names. So as we already know, NVIDIA has been on this parabolic move. We haven't really consolidated or really actually even went sideways. And this right here, I don't know anybody that wouldn't call this parabolic. This is an incredibly fast and sharp move. And this is a high market cap name, right? It's in the top 3. It's almost in the top 2. Like, it's not even too far away from taking out Apple. It's crazy to think that. But also it has its highest implied volatility. So this right here is the most dangerous aspect right now going into the market, where we got to hope for the best, where if it pulls back, which would be healthy for a pullback and consolidation, that would be healthy if you want this to go higher. But it's very unhealthy if it continues to press in parabolic fashion to the upside. Now, we do know Microsoft is one of the other larger market cap names there too as well. The number 1 spot, right? And this one's been holding up rather well for the year to date, and it's just consolidating, going sideways. So this is what I mean by, a nice contraction leads to expansion, contraction. So this looks healthy price action. So it's strong on the year, but it's not quite like that, right? And then you look at something like Apple, which I find very interesting, is Apple has been a name that's highly correlated to the S&P 500, but Apple has been selling off quite aggressively in these last trading days ever since breaking that 180. So one might have to think that if Apple's been selling off, right, Apple and Google, right, have been selling off, NVIDIA has been going straight up. My question here is, if NVIDIA just consolidates or continues to go up higher and Apple starts to bounce from these levels, and even Google, that could send an incredibly strong move or signal to the overall markets to continue to press higher. On the flip side of that, you can look at NVIDIA. If it comes off, will we see traders start to rotate back into things like Apple and or Google? That's another thing to potentially watch out for there too as well. Now, you've probably seen this chart before. This is kind of the mania phase, where you go through stealth, awareness, the mania stuff where you get these parabolic moves, and then the blow off phase. And it kind of goes through the multiple different emotions as you're kind of going through that parabolic stage. And you can go back through history and see various times that these type of things have happened. Like, for example, the South Sea stock. This was Isaac Newton's nightmare, where he invested a bit. He exited very happy, but his friends stayed in, and then he re-entered, and then he ended up exiting when everything completely blew up. You can also go back to things like the tulip bubble, how that exploded to the upside, all that FOMO, and then we completely imploded in on itself. I wanted to highlight more specifically the parabolic move, and this was online, the parabolic curve kind of pattern, where you can see typically you have these bases and it breaks out. And this, if you want to screenshot this and use this or download the chart deck for free, I have the link there in the pinned comment and the description. But this is built on by, I don't know who made this, but I just rebuilt it because every other copy that I saw, it was just super low, like a low quality photo. So I just redesigned it. It's the same look though. So as you can see, you get this parabolic move, and you have various bases, and by base 3 you have this breakout, and it says here at the end of point of base 3 it indicates where the X symbol is. The stock could double in the shortest period of time. So this is where you get that very explosive type move. And I just want to pull up a chart of NVIDIA, and you can go back to 2021. You can actually see this move through those kind of phases in parabolic fashion, where you have a nice base breakout, 2, and then 3. It didn't double to 100% move there, but that was like a 50-60% move. Then you have a little base 4 there. And then over here in 2023, we had, this base being broke out. You can call it a potential inverse head and shoulders. We broke out. So this could be base 1, 2. And then this was an 8-week consolidation over here in completely parabolic fashion. Now we haven't seen a 4, but what I will point out here, very similar to Cisco Systems back in 2001, which I do have a chart to share with you. This was at 500. So if it were to double, it was a little slightly higher than that. A 100% move could take us into the thousands of dollars per share for the price of NVIDIA, 1,000 to 1,100. If I go back over to, if I zoom in over here, you can see the different bases. I kind of labeled them out here if you want to kind of analyze it yourself. But you have this is in 2021 where we had this little base here, or consolidation. We broke out base 2, and then base 3 where we saw that explosive move. And then here's a little bit more of a zoom in photo in 2022 to 2023 of just how insane this move actually is, where you get a large base, it bases out again, and then we have a multi-week consolidation over here as well, where we get that explosive move. Very similar to one of the charts that I posted not too long ago, and also on Twitter, and I made a video about it, was the very similar type look of Cisco Systems and NVIDIA, where we consolidated for 8 weeks, and when we broke out of that, we saw that 100 was 120% move in Cisco Systems. We said if we move 120% in NVIDIA, that could bring us roughly to 1,100 or 1,000 to 1,100. So if I show you Cisco Systems, more importantly, dating back into 1998 to where we were, you can just see the parabolic nature of this and how it really kind of emulates the parabolic curve step-like formation that was on display over here. So you see this base 1 where we have basically going sideways, but you have some volatility. Base 2 was a lot better, where you have a series of higher lows, and then you have a back test. And then base 3 is when we exploded from it. That's the one that's highlighted right here on the weekly chart. And that's where we moved over 100%, and we built that base 4. And then basically that was into 2000, and this was when we crossed through it. That marked the dot-com bubble, and we didn't see it this high for many, many years later. Another one to look at is like SMCI, so super microcomputer. You can see we built a base here that could be considered base 1. This little consolidation to breakout could be 2. And then base 3 could be this longer one where you do see a series of higher lows, much stronger base there in base 3. And then this was right around earnings, right where we got that volatile move. But you do see a lower high, higher low. So you can maybe consider this a base as far as 4 goes. But this is right here, just incredibly strong move in parabolic fashion. And the reason why I'm pointing this stuff out is because the higher and the faster these things move, like I said, you got to hope for the best, but you at least have to be prepared for the worst to happen. AVGO, which is one that we just talked about in the earlier trading session, that when it came down to its earnings expected move, the impact that had quickly on the market, and that wasn't even NVIDIA. That's pretty wild to me. So if we look at AVGO, you can see here where we had this trend line break. You can potentially call that a little base or inverse head and shoulder right here. Then you can consider this potentially base 2, and then base 3 was longer, right, where you had multiple tags here, broke out, back tested, and we saw that explosive move from 900 to where we closed basically today at 1,400. And now we're probably, it looks like we're going to be up tomorrow morning, but we did take a sizable hit. So we'll see what happens come tomorrow there for AVGO. But let's just go to like an ETF, right? So semiconductors ETF. Semiconductors have been just, like I said, in parabolic fashion. And those are the main examples that I'm sharing with you. But base 1 here on semiconductors, right, you can potentially look at this as an inverse head and shoulder base, right? And we're kind of cracked this neckline over here, or just a trend line break. So you can consider maybe base 1. Base 2 over here, same thing, where we kind of consolidated here and broke out. And then base 3 was a little bit longer consolidation, where we saw the explosive move, right? So X marks the spot here from 145 to where we are at right now, about 235. And this is in an ETF, right? This is crazy. So I'm calling this out once again because not to say like, hey, like if you a lot of people will say, oh, yeah, you're bearish because you missed the move. I didn't miss the move. I hardly traded semiconductors. And this is, an equity curve of my P&L for the last year. I got a lot more into exposure towards September and October of the prior year. And the majority of the other year, I just didn't trade this account too frequently. But you can see that even here is kind of going in parabolic nature, because the S&P 500 itself has been moving up in parabolic nature. So a lot of stocks have been moving in parabolic nature. And this is to brag, to do that. It's to tell you, once again, from last video, we did the big warning. Here, it's about there's very little margin, and you just saw glimpses of that very quickly there on AVGO, but you also saw how volatile the market can get on very sudden announcements or earnings moves, okay? If we take a look at some of the intermarket principles, a couple other things going on is while this is taking place, you're seeing more of a flight to safety metal considered, right? A move into gold, and gold's been up 1, 2, 3, 4, 5 trading days in a row, making a huge break out of this base. Now, I will note that the momentum seems to be slowing here, and you can tell that by the range of the authority of the candles. So you get one big candle, right? And then it's a little bit smaller range, and then it's a little bit smaller range, and then it's a little bit smaller range, and now it's even a little bit smaller, indicating that the momentum, the authority is kind of waning here. So see how it pulls back, how it digests, if it wants to keep blowing up. But this is interesting because if you look at something like the copper to gold ratio, right? Copper is more of the economic metal, right? Gold is more of the safety metal, right? Copper is known to have a PhD in economics. And what you'll see here is the line has actually been going down, indicating that gold is actually outperforming copper, right? We know that if you look at a copper chart, copper's been flat. But the thing here to look back throughout history is when it typically goes down, it's in periods of not the greatest economic times, right? So for example, this was going down into the dot-com bust, right? This was going down into the great financial crisis. This was going down into 2011, where also the Fed had to step in, right? Even in 2015 to 2016, there was some stock market turbulence there, and we were heading down there too as well. But coming out of these levels, it also marked some pretty nice times where copper was outperforming gold by a wide margin. And even here into 2020, right? Boom, this was sinking down as the market was actually kind of going higher here. And then all of a sudden the pandemic hit, right? So that was more of a one-off, but I wanted to call that out because gold is outperforming copper by a pretty wide margin. The market continues to press higher, and this is kind of sinking off, which is interesting. So, what is causing this large move here in gold? It could be because obviously the dollar saw a couple of days of just incredibly authoritative bearish candles to the downside, which means that, when a rubber band expands, right, you can have snapbacks. So just be aware that if this thing snaps back, that can be what pauses gold in the near term to consolidate or to pull back. And then if you also look at something like TNX, the 10-year yield has been coming off too. And these are two things from an intramarket perspective that if you see the dollar back off, the 10-year yield back off, both at the same time too, it really depends on the rate of change that they move. But you also see when those both go down together, we've seen the markets rally. Actually in 2022, when these were coming off, the markets right here, both the dollar and both the dollar came off right here, boom, and 10-year yield, that was actually a time where the S&P 500 rallied quite hard, right? And you can see, right, well, I'll point it out right now, actually. Why not? Let's just take a look at it. Over here in October, where we saw this big rally, right? October up through on the weekly time frame. Well, when was the 10-year yield reverting? Well, it was in October, right? What was the dollar doing in October? Well, it was actually falling down there too as well. So when we start rising, that could be a potentially bearish sign. But the correlation kind of broke out here in 2024 where the dollar did rise, but it didn't really affect the S&P 500 by any measure. If you take a look at what asset managers are doing, they're also quite bullish here. We're getting a 93.99, so 94% reading, meaning they're 94% long based off of this survey. So this is something also interesting that it could be a contraindicator that if it gets way overextended or over 100, it means that they're leveraged long. It's a survey, so we don't really know what they're doing. But I'm pointing this out because as the market's pressing higher and higher, right, and everyone's basically long, that's why these can act as contraindicators, because then they have to flush back down or get back below the 50% marker if the market starts falling. Another interesting aspect here from an intermarket standpoint is looking at the 10-year 3-month curve. It's going to deeper inversion. You can see it's 138 basis points inverted. We haven't seen this look way out to the 80s, right? And we're in a rate hike cycle, but we're also coming to a period where Jerome Powell just said today during his testimony, if the economy says that if the economy does as expected, carefully removing restrictive stance will begin this year. When asked about the surge, when he was asked about the surge pricing models, he says companies need to have the freedom to set prices how they choose, but they are stating the fact that if everything goes how it is and as expected, they can potentially start reducing. Now, what does he mean by that? It means if inflation's coming down, right? If inflation starts to back off. But what would also force their hand to lower rates and cut the rates? Well, if something broke, chances are they would step in to do something about it. And when you go through the rate cut cycle, while we have the inverted yield curve, that's typically where when you start cutting, you start to get the uninversion. And if you look back to the 80s, right? When you uninvert, and start cutting rates, that's when volatility comes in, right? We uninverted over here. And by the way, the pink lines are highlighting that even though we were inverted and rates were high, we actually hit all-time highs every single time there, including where we currently stand right now, hitting all-time highs. But when we uninvert and rates come off, that's where we get that volatility. You can see even if you zoom in on the 10-year, 2-year curve, as it gets deeper inverted, it actually pushes the market up higher. So you can see when we went to inversion, this is the 0 line, deeper into inversion, the market rallied, deeper into inversion, market rallied, deeper into inversion, market rallied, and so forth. And you can see we went deeper into inversion, market rallied, actually started uninverting, the market went sideways. Then we went deeper into inversion, the market rallied again. So it goes to show you that if we do really start to begin cutting rates, or if we start to uninvert this yield curve, which it will happen at some point, we don't know when that's going to be and how it's going to look. But when we do, what's that going to mean for the S&P 500? History suggests volatility can easily step back in. So let's go ahead and dive into the S&P 500 now, because we got to get a little bit more tactical, right? These are more narratives and showing you like how things are setting up. And once again, there's little margin for error because of these parabolic moves and very high implied volatility, large market cap names that if they come off, it could potentially be bad if we don't start seeing them flow back into things like Apple or these other large market cap names like Google. So I wanted to start here looking at this interesting note from JP Morgan, Matt Reiner. But he said, today just feels different. I can't help but sense that we're at the apex of some unknown pivot point in the market. I can't shake it. For the first time in a while, we're seeing broad profit taking across mega cap tech, while passive in nature, the notional value bringing off. I'm not going to read it all, but if you want to go through it, go ahead and read it. But what it is pointing out, I'll highlight some of the main areas that the Gamma Labs bolded, but he says taking profits is healthy and responsible thing to do. Rulebook 101, sell when you can, not when you have to. I thought that was an interesting note there. And he said there's a lot of fundamental selling taking place apparently in the background. Fundamental long-term money is selling, and it feels like a technical momentum fear of missing out money is buying. And earlier on today's live stream, we talked about that looking into NVIDIA from a deeper perspective of options. And it does seem that it's more FOMO, or it's just short-term weaker hands trading the market higher. And unfortunately, if they trade at higher and higher and it's weaker hands, that means the move down could be just as aggressive. And once again, right, that's why we got to kind of hope for the best here, but you need to at least be prepared for what could potentially happen, the worst, okay? Everyone seems to love this 4,900 level on SPX2. Well, no one's indicating that their sellers X% higher, and that's worrisome. So people aren't really, once again, really worried. And I feel like we've been saying this, but now we're getting somebody from like JP Morgan, right? Bigger names saying this kind of same stuff. And if you look at the CTA positioning, we're in a very high percentile here of longs. Now think of CTA as kind of like algos, right? Momentum algorithms, but they're commodity trading advisors. So being that we're kind of maxed out long here, what happens if the market starts coming down, the S&P 500 starts coming down, triggering some of these momentum sellers? That could mean that the moves become a little bit more exaggerated to the downside. Now, going into tomorrow, we have a big report. We have non-farm payrolls and unemployment. But once that passes, we're right back on it again with CPI data. We have core inflation on March 12th coming out, and that's what the Fed has been just zoned in on, right? They've been zoned on unemployment and inflation. So what the Fed said today, right, what Jerome Powell said, if the economy does as expected, right, if there's no surprises here, well, then they're going to keep on this path. But if it comes in, above expectations, or if it's not coming off inflation, what does that mean? It means what? We're going to hold rates higher for longer? Perhaps. Now, if we take a look at percent of gamma that's expiring, March 15th is going to be one of the larger gamma option expirations. So March 15th is going to be an important day because a lot of the times you can move to very key gamma levels. And until we actually roll that gamma off, until it expires, there can be a pinning action taking place in the market where it kind of price gets hung up. And then this will free it up come after this day. But it's not only that, we're also going through a contract roll for various future assets. So we're going to be going, our front month right now, like for example, ES is ESH24, and we're going to be rolling to ESM24. So just be mindful of that taking place. If we take a look at SPY, it has been on a one-way ticket up, but I wanted to call out here that we are starting, believe it or not, starting to contract a little bit here. Now, I know people are going to look at this and be like, it's a rising wedge, it's bearish. I'm actually just pointing it out because once again, it's price actions just consolidating, it's getting tighter here. So you can see an explosive pop to the upside, maybe perhaps the 520, which is a key level to watch for, but it also can potentially break, right? Like, and then maybe we can watch for the NVIDIA gap, right? This move was driven by NVIDIA. Actually, this move was pretty much driven by NVIDIA looking at the correlation. But when NVIDIA reported earnings, like that was a big gap to move the S&P 500. We had a small consolidation and boom, we hit another all-time high today. Okay, now getting a little bit more tactical. On the week, we're basically flat to unchanged. We're slightly up. We already came down to tag our lower weekly expected move. And when we did that, the expected move for the remainder of the week was still massively large. It was about the same size, which means we can easily get a snapback. Now, I know people are going to start looking at the various indices and start to notice some rising wedge patterns. Okay, it is what it is. We have that economic data coming out tomorrow. We're above a rising 5-day moving average. We're above the month-to-date, week-to-date anchored VWAP. So as it stands right now, it's bullish in all checks, okay? Where can we potentially go to? I would say pay attention to the upper weekly expected move, the upper daily expected move. That's right around that 520 marker. And if we start getting hit to the downside, depends on what the market, if it depends on what really comes out as far as the data goes, but the lower daily expected move is in line in confluence with the month-to-date, week-to-date, and 5-day moving average all in this area. So if we get a hit, perhaps in this area could act as a level of support. Right? The data's coming out. When's the data coming out? The data's coming out probably an hour before the market opens up. Yeah, so we'll see kind of how that responds and reports, but that would be some key levels that I'm kind of honing in on. As we've already stated, the market did sell off to its lower weekly expected move, which was pretty in line with the weekly 5 EMA, and the weekly 5 EMA has been completely vertical here too, so that's been holding as a level of support. I'd say it'd be more bearish if it starts turning back around, obviously, and in order to do that, you need to close below it, but we haven't actually had a close below the weekly 5 EMA really since October over here. We've been closing above it, holding it above that every single week. Now, if we start to, close up in this area, some people might mark this as a hanging man candle. Guess what? We had a hanging man candle here, but it's only valid if we start closing below the prior low, right? So you can see we took out the high, so that negates it, right? So if we close like this candle, it would have to close below the low and not break the high. Okay, that's how you would read that. Now, let's get into even more specifically some gamma levels. Main concentration now is still at 5,200. It was at 5,100 down over here. All right, but it seems to have changed. Now 5,150 seems to be an impressive level. That was a nice 0-date level too. Price came into it, it rejected. Price came above it, pulled in. Now we're kind of around that area. But still, traders really want to get up to that 5,200. That's where the exposure's at. So if we do, for some reason, gap way up, pay close attention to that 5,200 level as a potential level of resistance, because if we get up there, it's going to be very hard until we start to have option expirations to really break free from this level because of the amount of gamma. First, it was 5,100, and 5,100, we came into it, we pulled back, we came into it, right? And we just chopped in this area because that was where the main gamma exposure was. And we can still very well come back in here. But you can see that as traders really started aggressively moving out to 5,150, we're trying to make more stabs up to the upside. So just be aware of 5,200. And then the other key one is 5,150, and then also 5,100, what has been a key level. It's not quite level mapped out right now though. And then our gamma flip level is an interesting one to continue to watch too. And that's currently at 5080. And this right here will tell us how dealers look to, how dealer action it was going to be. So if we're above it, you look to sell the rip, buy the dip, sell the rip, buy the dip, where volatility compresses. If you're below it, which we did get below it for a minute here, you see explosive moves. So like explosive move, explosive move, explosive move, explosive move as we came into this negative gamma environment, which, wasn't at 5080. It was a little bit different at a time. But that's all I got for you on today's episode, everybody. Hope it helps out and gives you some insight into what it is that I'm seeing in the markets. See you later.